Here's the truth. If trading indicators were really the secret to getting rich, Wall Street would have locked those things away a long time ago and you would never hear about them online. You would never be able to use them. So, why do so many traders chase the holy grail indicator only to end up frustrated and confused and wondering, I was promised this indicator would work, why didn't it? The truth is, indicators are powerful tools, but only if you know how to use them correctly. Today, I'm going to show you how to actually think about indicators, which indicators I trust, and why no tool on its own can replace a real trading plan. So we've covered candles in our other videos, so let's talk about the other thing that you're going to see on your charts, indicators. And before we jump in, please make sure that you like and subscribe this video because it really helps me out, and it makes honestly the time and energy that it takes to make these videos worth it to know that people are actually seeing them. So, what are indicators? Let's talk about that for a minute. What are indicators, and what aren't they as well? Okay, so let's get really clear for just a second about what indicators are. Okay, so indicators, they take things like price, volume, momentum, and data, and they turn it into something visual like a line or numbers or signals so that you can look at a chart and you can easily spot trends, patterns, and stuff like that. But here's the catch. Indicators are not a crystal ball, okay? They're not a shortcut. Indicators are definitely not a trading plan by themselves. And what happens a lot of times when I talk to traders is they fall for the hype and they think that if they can just find the right indicator, they will turn on the money printer and they'll just start printing money left and right. But if it was that easy, again, everyone would be doing it. Algos would program it and no one would ever actively trade again. See, the thing is, the real edge in trading comes not from indicators, but from understanding the market's big picture. Things like price action, context, volume, and ultimately your own edge in your own trading strategy. And so, the way that I want you to think about indicators is I want you to think about indicators as something that's there to serve your trading plan, not to replace your thinking, not to replace your trading plan. Okay? So in my own trading, I use indicators all the time. I use them as a dashboard. So what they do is they help me read what's happening, but I never allow indicators to steer the wheel for me. I never let them drive the car for me. So what we're going to do is we're going to dive into what are some common indicators and how do I use them. All right. Let's talk about moving averages for just a second. So moving averages are simply just the average price of a stock kind of smoothed out in a line over a certain period of time. So just to make the math easy, let's say that you choose a moving average with the number 10, like a 10 moving average. Well, what that's going to do is that's going to look back 10 candles and it's going to calculate an average. It's going to put a line on your chart to let you see visually what the average price is of that stock. Okay, so there's two types of moving averages that you're typically going to see talked about. The first of those is just a simple moving average. And so what this is this is just a straight average of a closing price over a certain period. So for example, if you're looking at a 50-day simple moving average, that's going to look back 50 days and then it's going to total those numbers up and divide it by 50 and you're going to have an average price that the trend line tracks. Okay, the other type of moving average is exponential moving averages, and so these are similar to a simple moving average. They're going to give you an average, but what they do is they actually give more weight as you get to more recent price action, which means it's more responsive to new information and it's more responsive to what's happening currently. So let me give you an example of what this looks like on a chart. I have two moving averages on this chart right here. The yellow moving average is the 9-period simple moving average, and the blue one is the 9-period exponential moving average. And as you can see that the cream colored one is a little smoother than the other one. The exponential moving average is a little more jagged, and that's because it's faster reacting to what's going on. Okay, so that is kind of a basic of what indicators are. So which indicators do I use and why? Okay, to keep it really simple, I try to pretty much stick to the simple moving average on daily charts, and on something higher than that. And the reason being is because that kind of smooths out price action on daily charts, and it's also more well known. And so a lot of swing traders and stuff like that are going to rely more heavily on a simple moving average. When it comes to exponential moving averages, what I do is I use those pretty much for day trading and anything shorter than the daily chart because those tend to react faster. And typically, because I'm not going to be in trades as long, I want faster price action. All right. So that's just kind of a hint on how I use moving averages. But let's talk about what moving averages show us. Okay. So moving averages are going to show us a visualization of the trend for one. Okay. So the general rule of thumb is this: if the moving average is pointing up, then the trend is up. If the moving average is pointing down, then the trend is down. And if the moving average is flat, then you're in a consolidating sideways market. The other thing that moving averages are going to show us is they're going to show us support and resistance. All right. So moving averages are one of the primary indicators that are used by retail traders. And many times they're looking to add or sell at moving averages. And so they can act as kind of support or resistance lines on your chart. And now that we know what a moving average is, let's take a second and let's talk about what some of the common ones are. And let's talk about what the main ones I use are. Okay? So here's some kind of common ones here. So one of those would be the 5-period simple moving average. I use this one all the time. This one is more about short-term momentum. So I like the 5-period simple moving average on the daily chart because there are 5 days in a week on average. And so this is kind of smoothing out the average price over 5 days. So I use that a lot for swing trading. The 9 exponential moving average is used by a lot of funds and algorithms for like intraday trades. And so I like that one as well on my chart because it kind of, you can see volume step in at key areas, and usually those line up with the 9 exponential moving average because a lot of traders and funds are paying close attention to that one. Another important moving average that you're going to see on a lot of charts is the 21 exponential moving average. This is also used by a lot of funds and algorithms for longer trades, okay? I like this one for swing trading. It's the only other moving average that I'll really put on a daily chart. And that's because this is about a month of price action, and so it's good for more of a medium length trend, maybe something you want to stay in a little bit longer. Another popular one is the 50 exponential moving average. If you're thinking in terms of like time periods, this is about a quarter's worth of price action. And so what this typically, the way this is used is if price is trading above the 50 exponential moving average on the daily chart, then the trend is up. And if it's trading below, then the trend is down. And so people tend to get more bearish if it's below, at least in the short term, the 50 EMA, and they're more bullish if it's above. And then the 200 exponential moving average is about a year's worth of price action. And most people consider the 200 exponential moving average or the 200 simple moving average as kind of a line in the sand level for price action. If you get below the 200 exponential moving average, usually the sentiment isn't just bearish. This is when institutions tend to get bearish and they start to sell, and the sell programs start to kick in on longer time periods. And then the opposite is also true. When you get above the 200 exponential moving average, then institutions tend to get bullish. And so one thing that people will look at, just to give you an idea of how these will work together, is people will look at the 50 and the 200, and when those cross, they call it a golden cross when it's to the upside, and they call it a death cross when it's to the downside, because when you have two moving averages headed down, that's usually not, and prices below both of them, that's usually not a good indication of the direction of the trend. So those are moving averages. Let's talk for a minute about another wildly popular indicator. And this is one that I use all the time as well. This is VWAP, or volume weighted average price. So VWAP, what that does is it calculates the average price a stock has traded at throughout the day. And then what it does is it weighs the price by the volume traded at those levels. And so this is a little bit different of an indicator because it resets every day. And so this is primarily a day trading indicator that's used for trades that you're going to be in and out of in the same day, since that level is going to reset every single day. And for those of you who are nerds and you want to know exactly how it's calculated, here it is on the screen right here. All right. And this is what it looks like on a chart. This is the purple line here is the volume weighted average price. Okay. And so this is what it looks like on a chart. And then what does it show us? Well, VWAP shows us a few different things. It shows us fair value. Okay. So when price touches the volume weighted average price, this shows you exactly where institutions and traders are coming in with volume to either buy or sell. Like that is the price where the most volume is hitting. And so you need to pay attention. And because of that, it also operates as support and resistance. So these areas are likely to act as places where you can place stop losses where you can take profit or you can get in on dips or even short pops to the other side because of what VWAP is showing you. The other thing VWAP does for you is it kind of gives you conviction in a trade. So when you combine the volume weighted average price with other indicators like moving averages, you can see not only where price is trending, but you can see where the volume is behind the trend as well. And that can actually help you out a lot when you're just kind of trying to get a quick, big picture of a trade. So that's the volume weighted average price. The next indicator that I want to talk about that's really popular and I like to use it is the relative strength index, or the RSI. Okay, so the RSI is just simply a momentum indicator, and it shows the speed with which a price has changed. So if price sells really, really quickly, then it will go down really quickly. And if it is bought really quickly, it'll go up really quickly. And so the default setting for RSI is 14. I actually like the 5-period RSI a little better. It's a little bit faster and it represents a week of price action as well. And so some important things to know about RSI when you've got it on your chart. Basically, if the RSI is over 70, that means it is considered overbought. And if it's below 30, then this slide is wrong. My apologies. If it's over or under 30, then it is considered an oversold price. Okay, and so let's talk about what this looks like on a chart here. Okay, so you can see here that when it is red, it is above 70, and this price has moved up quickly, and so now it's considered overbought. When it's blue, the price has moved down quickly, and it is considered oversold. And if you just look at this chart and how the price has reacted to it, you can kind of get an idea of how it's used by a lot of people. So when it's red and you've got this idea that it's been bought up really, really quickly, you get some releasing of that pressure to the downside, and eventually it hits oversold territory. And then what happens after that? Well, after it's oversold for a little while, we start to bounce up and we climb back up to overbought territory, and then back down to oversold, back up to overbought. This is kind of an idea of what this looks like for you, okay? And so let me talk about the way people typically approach it. The way people typically approach these kind of trades is they're looking for, like, every time the price gets into the red zone, they're looking to short, and every time it goes into the blue zone, they're looking for a pop. And that's actually not the way that you should approach the relative strength index, because RSI can cool down in either direction without a price reversion. It can bounce. If it's oversold, it can bounce up. If it's overbought, it can kind of sell off a little bit. You can get these pullbacks, but also it can go sideways as well. And as long as the price continues to trade sideways, a lot of times it can give back on the RSI as well. And so basically, what this shows you is something that we've talked about in other videos, and that is that after big moves in either direction, either higher or lower, the market just needs a little bit of time to reset, either through some profit taking and buying where the market changes directions on the short term, or by sideways action. So why am I talking about this so much? Because one, a lot of people use this indicator wrong. And second, because if you're going to use this indicator that way, the best way to do that is to understand that the RSI works best when you are trading in a trend and you are trading with a trend. So on the same chart, you can see here that we put in a higher low here, right? So we've got our low, we've got a high, we've got a low, and then we're climbing up again. And so right here is a higher low in a trend. Okay, so if I'm keeping that in mind, then when I'm going to be looking is not going to be in all of these other signals here. Where I'm going to be looking for entries is here when we are oversold in the direction of the trend. Let's talk about the next indicator that I really like to use a lot on my charts. I use this one all the time, and this is called the volume standard deviation indicator. What this just shows is how much volume deviates from the average volume for a set period of time. And I actually like to look back 20 candles to see how the current volume of the current candle relates to the previous 20. And so whereas on a typical chart, you're going to have a standard volume bar that can show you kind of some conviction behind the move, I like to also know where this stacks up above average, and that's where this indicator comes in. And so when volume spikes much higher than normal, it signals that something unusual or different is happening. Okay, and so this is what it looks like on the chart. Down here you can see these higher than normal volume bars, and the ones that are more abnormal are colored a certain color to let you know this is an abnormal move of the volume, okay? And the great thing about this is this actually shows the pressure as well. So buying pressure versus selling pressure. And so this particular indicator is not just showing the average volume versus current, but it's also showing whether buying pressure is in control or whether selling pressure is in control, and putting those together in one candle. And so this big blue candle here shows that's a sign of buying pressure. And so I want you to notice what's going on. In this chart, when it comes to the price action alone, the price is actually selling here, but there's a much larger than normal buying pressure going on. And so what happens next? Well, we quickly find a bottom, and then we start to climb here, okay? Something else that you'll notice on this chart is you can see that we have some very, very low volume as signified by these kind of dark blue areas here. That is coinciding with this dip right here in the market. And so look what happens next. When this selling is not on high volume, all this does is kind of set us up for the next move up. And so what I do with this indicator is I use this indicator all the time to validate my trade directions, to give me early warnings if a trade is falling apart, and to get an early heads up that something might be changing in one of the names that I'm following, regardless of what the price is saying. And so this indicator is an amazing thing that I use all the time. It's also custom and exclusive to our pro community. Okay, so this covers some of the most common indicators that I use and the exact ones that I use. Here's the most important thing that I want you to take away today, and that's this: that no indicator alone is a buy or sell signal. Okay, there is no such thing as a perfect indicator, and here's why. Every indicator that you're going to use for trading is based on what has already happened. And so if you rely on indicators alone, you are going to ignore things like market context. You're not going to be able to pay attention to things like breaking news. You're going to ignore the real-time price action of what's going on. And ultimately, if you're only relying on indicators, you will be behind if you're using them without considering the other factors. The real power of indicators comes when you put all of the stuff that you know about the market together and you use something that no one really talks about that much, and that is discretion. At the end of the day, you are not a robot. You are a discretionary trader, and you create rules around what is most likely going to happen based on what you know with all of the data and all of the information that you have, not just the indicator, the market environment, the context, where you are in relation to previous day's price action, and all of that stuff. So what does this look like for me? I want to start with the environment and the news, not with the indicators. Then from there, I'm going to move to price action in the context of what's going on in the market and the news. And then once those two things are lined up and I have a good understanding of those, that's where the indicators come into play. And I'm looking for alignment with indicators as confirmation that I am doing the right thing with my trades, not as triggers alone, okay? So the point is, indicators shouldn't make decisions for you. They should confirm what you are already seeing, and they should complement your trading strategies instead of being your trading strategy. Some of the common pitfalls that I see with indicators that I just want to cover really briefly is I see people over-cluttering their charts. Honestly, when it comes to trading, the less indicators that you have on the screen, the better. Simplify your charts, and it will keep you from information overload, and it will make you a better trader. Another common pitfall is believing in a holy grail, and I just want to tell you it doesn't exist, okay? No matter what you hear from the TikTok traders, no matter what you hear from the people flashing Rolexes and Lamborghinis, there's no holy grail. And then finally, a third piece of advice I have for you is just keep your trading strategies simple. What I'm going to do in this course is I'm going to teach you a few trading strategies to help you get started when it comes to that. And always remember that your trading plan comes first, and your indicators are very important, but they are the supporting cast in your edge and in your trading strategy. And as always, if you're ready to stop chasing the Holy Grail and you want to start building a money-making skill that no one can take away from you, the Legacy Profits Club is here to help, all right? We've got custom indicators. We have access to my entire trading playbook, and we have a network of traders who are serious about mastering the market alongside of you. You can find the link for that in my profile, and hopefully I'll see you inside.